Welcome to Business Stories, where we break down the fascinating world of finance, business, and investments through real-life stories. Today, we're diving deep into a topic that affects every taxpayer but benefits only a few: how big corporations legally avoid taxes. Picture this: a multinational company earns billions of dollars in profit, yet at the end of the year, its tax bill is close to zero. How is this possible? Are they breaking the law? Not quite. The truth is, the biggest corporations in the world have found ways to legally sidestep tax payments using a sophisticated network of loopholes, deductions, and offshore strategies. Now, before we get into the nitty-gritty details, let's clear up a common misconception. Tax avoidance is not the same as tax evasion. Avoidance is legal. Companies use existing laws to reduce their tax liability. Evasion, on the other hand, is illegal, hiding income or falsifying financial records. The companies we'll discuss today aren't breaking the law, they're simply taking advantage of it. But how do they do it? And more importantly, how does it impact the average taxpayer? To answer that, we need to explore the tactics big corporations use to minimize their taxes while keeping profits soaring. Let's start with one of the most well-known strategies: tax havens. Think of a tax haven as a financial paradise where corporations can stash their money with little to no taxation. Places like Ireland, Bermuda, the Cayman Islands, and Luxembourg have become go-to destinations for multinational companies looking to shelter their income. Here's how it works. A company like Apple, Google, or Amazon earns billions in revenue from sales across the United States. Instead of reporting all that profit domestically where the corporate tax rate might be high, they shift a significant portion of it to an offshore subsidiary in a country with a much lower tax rate. Let's say a U.S. tech giant generates $10 billion in profit. If they were to report that income in the U.S., they might owe 21% in corporate taxes. That's $2.1 billion to Uncle Sam. But if they strategically allocate those profits to a subsidiary in Bermuda where the corporate tax rate is zero, they save billions. The trick? Intellectual property rights. Companies register patents, trademarks, or other valuable intellectual property in offshore tax havens. Then their U.S. operations pay royalties or licensing fees to the offshore entity, essentially shifting profits away from the U.S. to a low-tax jurisdiction. It's called profit shifting, and it's completely legal under current tax laws. The result? These companies avoid billions in taxes while the average taxpayer has to pick up the slack. We uncovered how big corporations use tax havens to shift profits offshore and legally avoid billions in taxes. But that's just one piece of the puzzle. Today, we're diving into another powerful tactic: the loopholes hidden in plain sight within the U.S. tax code itself. Now, you might be wondering, how can companies get away with this when there are strict tax laws in place? The answer is simple. Many of these tax breaks and deductions were created by lawmakers, often influenced by corporate lobbying. These laws aren't accidents, they're built into the system. One of the most effective tax avoidance tools is corporate deductions. Think about it. Just like individuals can claim deductions for mortgage interest or student loans, corporations can deduct certain expenses from their taxable income. But here's the catch: some of these deductions are so generous that they wipe out taxable income entirely. Take Amazon, for example. In multiple years, the retail giant paid zero federal income tax despite earning billions in profits. How? Through a combination of deductions, credits, and stock-based compensation. One key strategy? Depreciation deductions. Here's how it works. When a company invests in things like buildings, machinery, or technology, they don't have to deduct the cost all at once. Instead, they spread out the deductions over several years, reducing taxable income year after year. In some cases, they can even accelerate depreciation, claiming huge deductions up front. For instance, let's say a company buys $1 billion worth of new equipment. Normally, they deduct a portion of that each year. But under special tax rules like bonus depreciation, they might be able to deduct the full amount immediately, lowering their taxable income to near zero. Another sneaky tactic is stock-based compensation. Instead of paying executives massive salaries, which would be taxed as regular income, corporations give them stock options. When those options are exercised, the company records the expense as a tax deduction even though it doesn't actually spend any cash. For companies like Facebook, Google, and Tesla, this trick reduces their taxable income by billions every year. And the best part? The executives still get rich while the company avoids taxes. Here's another popular loophole: the R&D tax credit. In theory, this credit was designed to encourage innovation by rewarding companies for investing in research and new technology. But in practice, it's often used by big businesses to slash their tax bills. Even industries that aren't particularly research-heavy, like finance and retail, find ways to claim the credit. The result? The government gives out billions in tax breaks, often to companies that were going to invest in research anyway. And who pays for these tax breaks? The average taxpayer. So far, we've seen how corporations exploit offshore tax havens and U.S. tax loopholes to minimize their tax bills. But there's another major piece to this puzzle: corporate lobbying. Ever wonder why tax laws seem to favor big businesses? It's no coincidence. Corporate lobbying is one of the most powerful forces in American politics. Here's a reality check: tax laws don't just appear out of nowhere. They're written, debated, and passed by lawmakers, many of whom receive funding from corporate interests. Lobbying is the process where corporations influence lawmakers to shape policies that benefit their bottom line. In simple terms, corporations spend millions, sometimes billions, to make sure tax laws work in their favor. Let's put some numbers on the table. In 2023 alone, companies spent $4 billion on lobbying efforts in the U.S. The finance, healthcare, and tech industries are among the biggest spenders. For every $1 a company spends on lobbying, they often get $100 or more in tax breaks and incentives. That's an insane return on investment. One reason lobbying is so effective is because of something called the revolving door. Many former government officials, especially those from the IRS, Treasury Department, and Congress, end up working for big corporations or lobbying firms after leaving office. Why does this matter? Because these people know the tax system inside and out. They help draft tax laws while in government and then later use that knowledge to help corporations exploit those same laws. For example, a former Treasury official might help write a tax break for multinational companies. After leaving government, they get hired by a corporation that benefits from that very tax break. The cycle continues: corporations keep their taxes low and the officials get lucrative jobs. One of the most glaring examples of corporate influence on tax policy was the 2017 Tax Cuts and Jobs Act, TCJA. Before the law, the U.S. corporate tax rate was 35%, one of the highest in the developed world. After intense lobbying, the TCJA slashed the corporate tax rate to 21%, saving companies billions. But here's the kicker: many corporations already paid far less than 35% due to loopholes. So the tax cut just made their bills even smaller. And guess what? Many of the lawmakers who passed the law had ties to corporations that benefited from it. Here's the harsh truth: when corporations pay less in taxes, someone else has to make up the difference. That means higher taxes for individuals because the government needs revenue from somewhere. Cuts to public services, less funding for schools, healthcare, infrastructure, etc. Growing income inequality: corporations and wealthy shareholders benefit while workers bear the burden. This isn't just a political issue, it's an economic one. So far, we've explored how corporations avoid taxes using loopholes, deductions, and lobbying. But there's one more major piece to the puzzle: how companies use shell companies and creative accounting to make their finances almost invisible to tax authorities. But there's still one more piece of the puzzle: how corporations use shell companies, secret deals, and accounting tricks to make their finances almost invisible to tax authorities. Let's start with shell companies. A shell company is a business that exists on paper but has no real operations. No employees, no products, just a legal structure used to move money around in ways that minimize taxes. Imagine this: a major U.S. company, let's call it Megacorp, wants to lower its tax bill. Instead of reporting its profits in the U.S., it sets up a shell company in the Cayman Islands. The shell company technically owns some of Megacorp's intellectual property, like a patent or a trademark. Here's where the trick comes in. Megacorp in the U.S. pays the shell company in the Cayman Islands for the right to use that intellectual property. The payment is structured in such a way that it erases most of Megacorp's U.S. profits because it looks like an expense. Meanwhile, the shell company in the Caymans pays no taxes because the tax rate there is zero. The result? Megacorp moves its money offshore, avoids U.S. taxes, and everything looks completely legal on paper. Now, you might be wondering, why doesn't the IRS crack down on this? Well, that brings us to the next point. Corporations hire some of the smartest accountants in the world not to cook the books illegally, but to make legal tax avoidance as complex as possible. One infamous accounting trick is called transfer pricing. A company like Amazon or Google has subsidiaries all over the world. When they sell products or services between their own subsidiaries, they manipulate the pricing so that most of the profit ends up in a country with low taxes. The result? Their profits look tiny in high-tax countries and huge in low-tax havens. And here's the kicker, because of corporate secrecy laws in many tax havens, it's almost impossible to trace where the money actually goes. Now, let's talk about the enablers of tax avoidance: banks, law firms, and accounting firms. Major financial institutions help corporations move money through complicated webs of shell companies, making it difficult for regulators to track where profits are going. Law firms create legal structures that allow corporations to claim tax breaks that Congress never intended to be used this way. And let's not forget the big four accounting firms: Deloitte, PwC, Ernst & Young, and KPMG, which design some of the most sophisticated tax avoidance strategies in the world. These firms don't just advise corporations on how to pay less tax, they actually help draft tax laws by working with lawmakers. It's a perfect cycle. Corporations hire accountants and lawyers to reduce their tax bills. These firms lobby lawmakers to create loopholes that favor their clients. The loopholes become law, allowing corporations to avoid even more taxes. And who gets left behind? The average taxpayer. Sometimes tax avoidance gets so extreme that governments are forced to take action. One famous example is the Panama Papers leak in 2016, a massive data breach that exposed thousands of secret offshore accounts used by corporations, billionaires, and politicians. The documents revealed how we've explored how big corporations legally avoid taxes using tax havens, loopholes, lobbying, and shell companies. We've seen how corporations shift profits offshore, manipulate tax laws, and use accounting tricks to keep their tax bills shockingly low, sometimes even at $0. But now comes the big question: can anything be done to stop it? Or is the system too broken to fix? Governments around the world have tried to close loopholes and force corporations to pay their fair share. But every time a loophole is closed, corporations find new ones. Take the OECD's Global Tax Reform Initiative, for example. In 2021, more than 130 countries agreed to a global minimum corporate tax rate of 15%, a move designed to stop companies from shifting profits to tax havens. The idea was simple: no matter where a company moves its profits, it would have to pay at least 15% in taxes. Sounds great, right? Well, not so fast. Some countries have loopholes even within the minimum tax system, allowing companies to still avoid paying the full 15%. Some of the biggest tax havens, like Ireland and the Cayman Islands, found ways to work around the rules. The US itself has struggled to implement the tax, largely due to corporate lobbying. So even though this reform was a step in the right direction, it's far from perfect. Shell companies in Panama, Switzerland, and the British Virgin Islands were being used to hide corporate profits. Multinational corporations were avoiding billions in taxes while everyday citizens were paying their fair share. Governments were losing trillions in tax revenue due to these offshore schemes. The leak caused global outrage, leading to investigations, resignations, and even arrests of government officials in multiple countries. But despite the scandal, tax havens still exist, and corporations still use them. Fixing corporate tax avoidance isn't easy because the biggest corporations have enormous power. Here's why real change is so difficult. Corporations influence lawmakers. As we discussed in Part 3, corporations spend billions on lobbying to make sure tax laws favor them. Many politicians depend on corporate donations to fund their campaigns, which means they're unlikely to push for aggressive tax reform. Tax havens have no incentive to change. Countries like Bermuda, the Cayman Islands, and Luxembourg benefit from being tax havens. Their economies depend on corporations using them to shelter profits. Unless every country agrees to stop being a tax haven, companies will always have somewhere to shift profits. Legal loopholes keep evolving. Even when governments close tax loopholes, corporations hire armies of accountants and lawyers to find new ones. The tax code is so complex that new loopholes are created all the time, sometimes without lawmakers even realizing it. Even though fixing corporate tax avoidance is difficult, it's not impossible. Here are some potential solutions. Stronger global cooperation. If all major economies truly enforce a global minimum tax, it would make it harder for companies to escape taxation. However, this requires every major country to stay committed, and that's a big challenge. Closing the loopholes for real this time. Governments could make aggressive reforms to prevent profit shifting and tax avoidance schemes. For example, they could ban certain offshore accounting tricks, limit tax credits for corporations that already pay low taxes, and increase transparency in tax reporting. A public country-by-country reporting system. Right now, corporations don't have to publicly disclose where their profits are being taxed. If they were forced to reveal this information, it would make it much harder for them to hide money in tax havens. Stronger enforcement against corporate tax abuse. The IRS and other tax agencies could be given more funding and resources to go after aggressive tax avoidance. In recent years, the IRS has been underfunded, meaning it often doesn't have the staff to audit large corporations effectively. Here's the reality: corporations aren't going to willingly give up their tax avoidance strategies. As long as loopholes exist, they'll keep using them. But there's growing public pressure to fix the system. More people are demanding tax fairness, and governments are being pushed to act. For example, European countries have been cracking down on tech giants like Apple and Google, forcing them to pay billions in back taxes. The US has proposed higher corporate tax rates to offset the revenue lost from tax avoidance. Activists and journalists are exposing tax havens and offshore accounts, making it harder for corporations to hide. It's an uphill battle, but change is possible, if there's enough pressure to make it happen. So, what have we learned? Big corporations legally avoid taxes using loopholes, offshore accounts, and complex accounting tricks. They spend billions on lobbying to keep these loopholes open. Governments struggle to close loopholes because tax havens and corporate power make reform difficult. But change can happen if there's enough political will and public pressure. At the end of the day, tax avoidance isn't just about numbers on a spreadsheet, it's about who pays the price. And right now, everyday taxpayers are the ones picking up the bill. And that wraps up our deep dive into how big corporations legally avoid taxes. If you found this episode insightful, make sure to like, share, and subscribe to Business Stories. Let's keep these conversations going. Until next time, stay informed, stay curious, and keep questioning the system.